Hello everyone, welcome to my channel 12 Call. My name is Ankit. We are going this series of stock market fundamental analysis. Please go through my disclaimer section. Also, a word about me. So we have already covered EPS and PE, and today we are going through PEG, projected earning growth ratio. So what is PEG and how it's calculated? PEG ratio is defined as PE ratio divided by earning growth rate. So stock PEG is current price divided by earning per share EPS divided by earning growth. So let's understand with the help of an example. Let's consider stock price is 100 rupees and earning per share is 5 rupees. So P by E ratio will be defined as 100 divided by 5, which is 20. Now let's consider projected growth of the company share is 30% for the next year. So PEG ratio will be defined as 20 divided by 30, which is 0.667. How PEG ratio is used? The PEG ratio allows us to determine stock's value considering company's earning growth. Please note, it's important to note that there is no universal rule that would indicate whether stock is overvalued or undervalued. Now let's compare two companies from the same sector using PEG. We have a company A where PE is 20, growth is 15%. So PEG ratio is 20 divided by 15, which is 1.33. A company B where PE is 22 and PEG is 25. So PEG ratio is 22 divided by 25, which is 0.88. Let's understand. So stock A has lower PE ratio and the market still overestimates its earning potential. PEG ratio of the stock A is 1.33, suggests that market is currently overestimating it by 33%. Hence, it's overvalued. Okay, company B. Even though stock B have higher PE ratio, it's still trading at discount when it's considering to its future income projection. PEG ratio of B is 0.88, which suggests that market is underestimating its earning by 12%. Hence, it's undervalued. Let's understand high and low PEG ratio. A PEG ratio greater than 1 suggests that stock is overvalued and less than 1 suggests that stock is undervalued. Peter Lynch. Those of you who don't know Peter Lynch is one of the most successful mutual fund manager in America. He have generated 29% return for consistent 13 years. Okay, so Peter Lynch suggests that a PEG ratio of 1 denotes equilibrium between the perceived value of the stock worth and its earning potential. Let's look at some of the limitations of the PEG ratio. A PEG ratio is less appropriate for the lower growth company. Large, very well established company have a slower growth rate compared to new growing company. Let's understand using an example. Let's consider an IT company with 5 lakhs employee and a very small startup IT company with 500 employee. So a 20% growth in a big company means nearly adding 1 lakh employee. Whereas a 20% growth in a small company means just adding 100 employees. So we cannot compare these two using a PEG. Another thing, a company's growth rate is just an estimate. The estimate is subject to a limitation of projecting future event. The future event are ever changing. Hence, correct accurate estimate cannot be made at all the times. Next, the absolute company growth rate using PEG does not account for overall growth rate of the economy. Hence, an investor must compare the stock PEG to average PEG across the industry and the entire economy to get the accurate sense of the how competitive a stock for the investment is. So that's all for today, guys. Please subscribe to my channel. Thank you.